This is Ben Russell from the AMP Tradeway Division. Looking forward to spending some time with you today. Welcome to our webinar. We're going to be talking an awful lot of really interesting subjects today about how to protect accounts over $250,000. Thanks for spending your time with us today. We are really looking forward to being able to share with you some pretty amazing information. And I just want to give you an overview of what you can expect from our webinar today. And we're going to be talking about the stability of our financial system, the whole system. We're going to talk about some of the things that maybe you haven't really thought about before. What is this FDIC, and what is insurance, and what is a Federal Reserve, and what is its role, and how does it work? All of that and more is what we're going to be talking about in today's webinar. But more importantly, we're going to be telling you why it matters. See, we're going to be able to lay these concepts out for you, but by the end of today's presentation, I think you're going to understand why we believe it's vital for you to have this information in advance so that you can begin to start to make some decisions. My friends, my name is Ben Russell. I am a part of the AMP division. I'm a director of client services, and my role is to help make sure that friends just like you get the help that they need from Tradeway. And I'm going to be one of your primary hosts today, but I'm not going to be the only one. So the other two individuals are going to be here. Jenny Taylor, our investment advisor, as well as portfolio manager. Jenny's going to be helping us out. And then David Verbugen is also going to be on. Into the subject matter. A lot of things to cover today, some very interesting things. And it really does come down to the fact that you and I were blessed to be a part of the United States economy. And normally the US economy is extremely stable. But the way in which the Fed functions, the way in which the Fed policies flow through, well, it's created a pretty phenomenal system for all of us. And the growth that we see, the economic prosperity, comes from the monetary system the Federal Reserve has been a part of helping to create. And what it comes down to, and there's some things here that maybe we don't quite get as to why it's so prosperous, but it really comes down to the monetary supply, how money flows in and out of the economy, how you and I as participants get to use our funds to buy the things that we want, how companies and businesses can use the money in the system to grow, to produce products. It's a mutually beneficial thing. And the Fed is behind most of what it is that we see happening, and it's mutually beneficial. That's the key. Mutually beneficial, so we all act in our own self-interest, which happens to be in the same self-interest of many, many other participants in the system. It creates the financial system that we all enjoy. So as stable as what it's been historically, however, it's not always stable. There are times of, shall we say, instability where things aren't stable. During those times, well, often the actions of the Fed, their attempts to exert control can often backfire. For example, as they raise interest rates. As they raise interest rates, this is typically when historically we see, quote unquote, and you're going to hear me say this a lot, so I'll say it in air quotes, something breaks. When quote unquote something breaks, usually it's because the Fed has been taking some action. Usually it's because there's unforeseen consequences in the action that the Fed is taking, and their policies cause some of our most significant times of instability. Now, the Fed has been doing some very interesting things, and our team is going to be talking with you about it. But our first point here, the impact of the high interest rates does bleed through into the entire system. I like to think about this from a perspective of us as consumers. Let's talk about it from that side. Inside the banking system, when I go to buy a home, David, have you bought a home recently?
I bought one 6 years ago, but we've refinanced since then.
Well, let's say you were in the market for a house right now. You know what you'd be paying for about a 30-year mortgage?
It should be right around 8%, give or take a little.
Okay. Now, would you expect to pay more interest, David, on a 15-year mortgage or on a 30-year? Which would you expect?
Generally, I would expect to pay a higher interest rate on a 30-year mortgage and lower on a 15.
Okay. Well, what if I told you it was the other way around in the banking system right now? That you actually, as you loan money to people like the government, they're paying you more money to loan them money for a short-term period of time, like 3 months. If you loan me money for 3 months, I'll pay you over 5%. But if you want to loan me money for 10 years, I'm only going to pay you about 4.3. Does that sound realistic to you?
Ben, that sounds kind of upside down to me.
Yeah, it is. It's upside down, and it actually creates a significant amount of instability in the overall system that you and I are a part of. And what ends up happening specifically, our second point, is that the bonds that underscore everything that we do in our debt-based economic system are now doing something that's really odd. And Jenny, I want to ask you this question because it's not intuitive, it's not obvious. When rates rise, what happens to the value of all those bonds?
Yeah, the bonds actually lose value as interest rates rise. And the opposite is true when interest rates go down and lose val or move down, the value of the bonds will increase. So they have an inverse relationship to each other.
Yeah, it's pretty crazy for us to think through this, but I think if I ask just a clarifying question, I'm going to ask it this way. So Jenny, if 2 years ago I was able to sell a bond to the United States government and the United States government was willing to pay me 1% on my 10-year bond, does anybody want to buy that bond from me today at the 1% interest rate?
Not when they can get 4% or something like that.
Oh,
If they bought a new one.
so then what would I have to do if I've got this bond and I really got to sell it because I need the money from it? What am I going to have to be willing to do for that bond?
Take a loss on the investment.
Oh, so like the most stable financial instrument, these things that we call bonds, which are supposed to be the safest thing in the world, which most of us think can never lose money. Can they lose money?
Well, they can if you're going to sell them before maturity, before the date that they would be mature.
All right, so that's the key. So what we find here is that because of the way in which these interest rates are working, getting paid more for the short term than the long term, unless you can hold it all the way to the maturity level, you're going to be taking a loss if you have to raise capital. Keep that in mind as we go through our presentation. So let's get on, let's keep going. There's a few more things. I just want to lay that as a foundational element. It's actually the key for the quote unquote something that we are expecting to see break inside the economic system. Before we get there, let's talk a little bit more about some of the other parts of the system that maybe we've not been all that exposed to. You probably heard it on advertisements. Understanding the FDIC. Now, FDIC is all about how the Federal Reserve and the systems and the different agencies are set up to be able to help to protect your money. And the reason why you need that protection is because in actuality, your money is not available at the bank. What? Yeah, see, that's the key here. What happens inside the US system, inside all banking systems, it's called a fractional reserve banking. And it's at the core of all the systems. The core of all the systems. And what's at the core of that system? Well, it's debt. So you and I go give money to the bank. Let's say I give $500,000 to the bank. Does the bank hold that $500,000 in the bank? Can I just, walk up to the bank vault and get $500,000 out? You guys tell me, what do you think in the chat window? I put $500,000 at the bank. Can I just go walk up to the bank and get $500,000 in cold hard cash? No, it's not the way it works. And see, what they do is they take all of our deposits, they bring all of the money in, and then they start to loan the money. They only hold a very small, what they call a fraction, what they call a reserve of your money in a liquid form that you and I can actually get to. So what they do instead is that they start loaning the money out. And I think it's really interesting to think about what ends up happening if something starts to break. We'll ask those questions as we go on a little bit more. But the fact is, our money is not actually in the bank. It's been loaned out. And if we all ask for our money back all at the same time, well, that creates a problem. And that's the reason why the FDIC insurance was created. See, they have to have a stable system. They have to have some sort of a floor. Otherwise, nobody would participate in the system. So the government created a program called the FDIC, the Federally Deposit Insurance Program, helps to protect your assets. So David, tell me a little bit more. What is this FDIC all about?
Yeah, Ben, the Federal Deposit Insurance Corporation. So they help oversee and safeguard bank deposits. This is really in your best interest, right? So it's basically insurance on your account up to $250,000, which is great for most people. But if you've got over $250,000 in that account, you may need some extra protection. And that's what we're here to talk about.
All right. So in my analogy where I gave the bank $500,000, am I protected up to that amount of money?
Nope. Nope. Only up to half.
Wow. Okay. Well, that's interesting. So if my account is greater than that threshold, I probably need to start thinking a little differently. Why? Well, because sometimes banks fail. So let's talk about some of these recent notable bank failures. Silicon Valley Bank, Signature Bank, First Republic, Citizens Bank. Banks do fail. And typically it comes down to that quote unquote something breaks. Well, let's talk a little bit about what might have caused something to break Silicon Valley. Jenny, what was this one all about?
Yeah, so Silicon Valley Bank in California, this is the first bank that failed this year, and we probably all remember it because the market really took a dive after that. But so aside from loaning money out that you deposit at a bank, banks will also use some of those deposits to invest, to try to make some income for themselves, for the bank, off of your deposits. So SVB was actually heavily invested in bonds and other fixed income securities. And as we've already discussed, bonds and fixed income securities lose value when interest rates rise. We'll spend some more time talking about that, but the interest rates have been increased in the fastest ever recorded history with what the Fed has done over the last 11 rate hikes that they've done. So what happened is SVB here failed after it had to sell its treasury bond portfolio, and this became known to depositors who had major concerns of the liquidity of being able to get their cash out of this bank, and it caused a bank run. So then the bank was actually closed. Now, so again, it collapsed due to deficiency in risk management surrounding the bond portfolios. But also there was a lack of proactive supervision by the Federal Reserve, the chair there in California. And for the first time in history, the Fed, not the FDIC, the Fed stepped in and oversaw the offloading of all of the assets to other banks, which then took over the accounts. So it actually, what happened is the Fed saw all insured and uninsured deposits. They made sure they were all covered, both insured up to the 250,000 and above that. So normally the FDIC comes in and covers the insured portions of people's accounts. But this time the Fed actually stepped in. I'll also mention the First Republic Bank, another California bank that closed, that failed. This was the second largest bank fail in American history. And it had actually loaned out more money than it had in deposits. Its loan to deposit ratio was 111%. So it loaned out more money than it had. And I believe they're only supposed to loan out kind of a max of about 90% of their deposits, or invest that. So again, this just proves that there's just a lack of oversight happening specifically in California with the Fed chair there in California, with two large banks failing just this year. But Ben, I kind of wonder, do you think the Fed's going to come and bail out the little man? Most of the depositors at SVB were actually venture capitalists, which have a lot of money.
That's the crazy part about this, Jenny, is that the Fed did something it's never done before, because most of the depositors at SVB were well over $250,000. These were the large venture capitalists. These were some of the .com. There was a lot of money invested at Silicon Valley Bank, and almost none of their depositors. Upwards of 95% of their depositors were over $250,000 limit, which is the reason why the bank started to fail so quickly. So the Fed felt like they had to step in and do something very unique and different. But that was for the big boys. That was for the institute. That was for some really large money. Well, the most recent bank failure that just happened a couple of weeks ago, that's not what they did. They just let the little people, the Citizens Bank of Iowa in Sac City, Iowa, just a very small community, They failed because they were giving loans out to the transportation sector, to the freight industry specifically, these really large, big rigs that cost lots and lots of money. They had a lot of those on the loans. A lot of those were loaned out. And if you haven't recognized it yet, which is actually kind of a sign that there's some trouble coming, the transportation sector, the freight sector, there's been lots of bankruptcies in that area because they can't actually profitably operate in that space. They bought all kinds of equipment during COVID and during the rush to be able to get everything into the system. They really scaled up when money was cheap and they overbought on the assets. And now they're going out of business. And what happens to the assets that they bought at inflated prices? Back to the banks. The banks can't sell those for the asset price that they're due. And this bank in Iowa actually was taken over by the FDIC because they were in danger of failing. There was a bank run. Now, the Fed didn't step in. This was FDIC. And how much were they insuring their depositors to? $250,000. So in my situation, if I was at Citizens Bank and I had a $500,000 account, the FDIC would be very much giving me some bad news. Mr. Russell, thank you for your business at Citizens Bank. However, we are regretting to inform you that your deposits to $250,000 are covered, and we will let you know when you can get to your money. Above and beyond that, they will not cover it. That's pretty interesting. So let's talk about the role. Yeah, I don't want to get that letter. You're right, David. So that's sort of what's going on in the banking system. Some of those things where something broke. Let's talk about, what this Federal Reserve is all about. How did it come to be? Why is it that they are a big part of what we do? And let's talk about how they kind of rule everything that we're in the process of trying to take advantage of inside the country. So the role of the Federal Reserve, mandated by Congress, the Congress of the United States actually gives the Federal Reserve its authority, and it conducts the nation's monetary policy. Their goal, and you'll hear this a lot, you'll hear Powell, Chair Powell, when he's in his presentations, he will almost quote this verbatim, our dual mandate to promote maximum employment and stable prices in the U.S. economy. That's what the Congress has chartered the Fed to do. That promoting of that stability of the financial system, well, that's interesting because what they're really trying to do is they're trying to prevent something from breaking. What we would call a systemic or a system-wide risk is really what they're trying to avoid. And when prices inflate too quickly, that creates systemic problems that could collapse the economy. So they're very much against this thing called inflation. And inflation is the other side of price stability. When prices are stable, they don't really go up very fast and they don't go down very fast. What the Fed is trying to do is to not have things move up too quickly and not have things move down too quickly. That's the stability that they seek. And it's for the United States economy, but is that the only economy? Well, it's global because the United States is the global system that every country is tied to. So they are creating global stability with their policies. Jenny, what's going on here? What's the other role of the Federal Reserve?
So another role, so these are actually, they have 5 roles, and we got this off of their, like, the actual Federal Reserve website, right? So the third role here is to promote the safety and soundness of individual financial institutions. So they need to promote that, the safety of, where we have our money, and that's where they oversee the banks. And then in that process, they are overseeing and shepherding payment and settlement system safety and efficiency. So they want to make sure that all of the transactions, the transactions, the US dollar transactions and payments are being done with safety and efficiency. So that is another role that they play.
Well, and it's a key part of the reason why the United States is the global standard when it comes to these transactions. Those US dollar payments, they undergird just about everything globally when it comes to international commerce. So this is a pretty big role. And as United States citizens, we get the benefit as part of that system. So the role of the Federal Reserve continues into this concept of consumer protection. I mean, that's you and I, that's the people that are in the system. And what they're also trying to do is to create an environment in which our funds can be safely invested. Why? Because then we're going to be comfortable with investing our funds. So they create the administration policies, the consumer protection laws, and the regulations associated with the financial system. So the Federal Reserve goals, according to Congress, let's just review them quickly. It's maximizing employment, stabilizing prices, and moderating the long-term interest rates. So David, I talked a little bit about that. Can you tell me again, what was stabilizing prices? What was the goal with stabilizing prices there?
Yeah, Ben, we're simply trying to control inflation. That's all we're trying to do.
And is inflation a little high right now?
Just a little bit, especially when you look at food costs, that kind of thing.
Yeah, I think that we all recognize that. So the Fed is doing what they can to be able to try to bring those prices down. And what is the only real tool that they have? Well, it's this concept of what is known as an interest rate. And their interest rate, the rate that the Federal Reserve provides to the banking system, becomes the floor for everything we do debt-based in the entire system. So their primary hammer to be able to control inflation is to increase interest rates. Interesting. I think we described a few minutes ago how sometimes when you start to increase interest rate, it's going to have unintended consequences to the entire system. Keep that in mind as we go forward with our presentation. So the impact of the Federal Reserve, unfortunately, from history, what we can tell is that typically the Federal Reserve has a really hard time getting it right. They do. They have a hard time because of the way in which the economy functions. They typically act in such a way as that they continue to raise interest rates until something moves. I'm going to put that something in air quotes again. Something breaks. Here's some examples. So the largest tool that they have, these interest rate policies, I just want you to recognize that over here on the left side of this chart, this is the interest rate that the Fed is offering to the banking systems, right? Here is the interest rate. Down here is the time frame. And I want you to pay attention to these gray bars. What these gray bars, they represent times in which the economy is contracting. We call it a recession. So back in the 2000s, what we saw was interest rates kept rising and rising and rising. They were flat. And then they started to fall as the economy went into a recession. Now I'll show you in a couple slides what happens to the S&P when that occurs. But take a look. In the recession, the Fed keeps lowering rates, lowering rates, lowering rates, lowering rates. Benny, help me out here. Why would the Fed be lowering rates?
Well, they're trying to bring the country out of that recession. So they are actually, this is to do with their monetary policy. So you'll often hear the words dovish or hawkish, right? And that has to do with what type of monetary policy are they currently putting forth. When they are raising interest rates, it's a dovish policy. They're trying to, it's a loosening policy. They are increasing the money supply. When they are raising the interest rates, they are trying to, I said increasing, they're trying to reduce inflation. They are trying to tighten the money supply to try to cool the economy down. Again, when it's the loosening policy, they're trying to speed the economy up. So they're in this game, this limbo of trying to control inflation, how the growth of the economy and all that, but it's not a perfect science for sure.
Right. So I like to think of this as a pendulum. The interest rate goes to high, and then stuff starts to break, and then they start to bring it back, and then they typically have to go way farther. This pendulum swing happens, and typically it's in the time of the extremes of that pendulum is when the something starts to break. And that's what we want to be able to underscore for you here is these things don't happen all that often. The extremes, the sides of the pendulum swing is where we really want to start paying attention. And we can see just based on this chart, it comes up, pendulum starts to swing, and as they start to lower the interest rates is typically when the strongest declines, the recessions are going to happen in our economy. Let's come out to current day. Look at how quickly they've raised rates, faster than any other time in our history. They went from almost zero with COVID. Look, rates were there. And then in response to COVID, rates went to zero. We are now coming up off of zero, and they've risen faster on a percentage basis than any other time in our history. Now, if I'm a pattern guy, which most of us as traders were patterns, up, down strong, up, flat, down strong, flat, 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 up, down strong, up. What do you think comes next in the pattern?
Well,
All right.
my concern, I'll tell you what my concern is that inflation remains sticky. We go into a recession and they can't reduce interest rates because then that will cause inflation to get worse. So this is where we keep kind of coming back to, like, this could be something that breaks. And this has to do with kind of the next slide. So why don't we go there? So
All right.
the balance sheet
Federal
of the
Reserve
Federal
balance
Reserve.
sheet, Jenny. Go ahead. Why don't you
Yep.
talk about this one?
Yeah, the Federal Reserve currently is holding about $8 trillion on its balance sheet, which are assets. However, these are assets that they have to pay back because they are mostly treasury bonds. So back in early 2000s, it was just under $1 trillion. And then you'll see during the 2008, 2009, and the great financial crisis, when they bailed out the banks, that increased by about 2.5 times or 1.5 times. And through the Obama years, they did what's called quantitative easing. So this was to help increase the money supply. It helped the economy grow during that time. The stock market did very well due to the quantitative easing, which was the selling of the treasury bonds. Then, as you'll see, it kind of evens out. Trump is elected in 2016. And through his time, thanks, Ben, you're going to see it kind of level out and actually start getting reduced. However, then COVID happened, and you're going to see that it doubled almost again. And along with, that's when they took interest rates to zero. So this kind of goes the opposite of that. Interest rates are low. They do this quantitative easing. It helps to, grow the economy, increase the money supply. And when they did start raising the interest rates, they did start tightening and reducing the balance sheet, and that's what we see here. So again, the concern is that this is just unprecedented. It's never been this high. There's a lot of concern of how are they going to be able to pay this debt back with these treasury bonds, and what quantitative easing may have done to the economy. Well, we clearly see that it caused a lot of inflation, and now they're trying to combat that. But the issue is if do we go into a severe recession, or a recession, maybe not severe, but does inflation remain high? And then they aren't going to have these same tools to be able to do that, because at this point it would be conflicting with each other. Trying to get out of a recession would increase inflation. So they can't keep stable prices in that scenario. So that's one of the big concerns right now.
This is another area where we're just calling out data points of something that, well, we've never really seen a historical precedence for it, but it adds to the pressure of the quote unquote something could be ready to break. Will it be? We got some speculations. We'll share those later in the webinar. Why is it not advancing? There we go. So when something typically breaks, that quote unquote something, it's normally from what is known as that rate inversion, where you're getting paid more for the short term than what you are the long term. That is just not normal. And there's this lag. That's the term that they use, this lag, this gap of time that occurs between when the inversion starts and when the quote unquote something breaks. Why? It's because these inversions, these long-term versus short-term debt cycles, it's actually what creates the entire system that we're a part of. And it typically takes a little bit of time for the impacts of that inversion to really start to cause things to break. Now let's go back and let's talk about some of the things that have broken in the past. With the dot-com crash, it was all about asset prices that were so inflated they weren't worth what the stocks were functioning at. And it caused a significant amount of problems in the long-term systems related to these debt cycles. What about the mortgage-backed security issues? It's supposed to be the most stable of all debt instruments. In 2008, when those instruments started to come due because of these inversion issues, they had a significant issue that nearly destroyed. What's the quote that we talk about from Buffett, Jenny?
He was concerned that the Western world as we know it would just have been gone.
Wow. All right. So these debt instruments that are a part of the fundamental part of the economy that most of us are never even really exposed to, it's the foundation upon which everything we do operates. And I think we can see that there's a lot of pressure on that foundation. So let's talk about that inverted yield curve, but let's put something on it that we all really care about as investors, the S&P 500 and the value of the S&P. What this chart does in one very succinct way, it gives you the way in which we can begin to understand the economic impacts of these inverted yield curves. We can begin to see the lag that occurs and then the impact to the economy that typically follows. So let me just show you this real S&P 500 is the blue. So the value of the S&P is this blue and red line. These gray lines represent when did the economy go into a contractionary cycle. So the S&P went up, we were inverted, and then it took a little while for the inversions to happen. And as the inversions happen, typically what happens is the economy goes into a contractionary period. Let's look at these more modern times where it's a little bit more obvious. The S&P goes up and up and up and up, and then we have a period of time. Typically, it's anywhere between 9 to 18 months. And after 9 to 18 months of an inverted yield curve, that's when we went into a recession. And look at the impact in the year 2000 that we saw to the equities. That was a substantial decline. Same thing happened in 2008. An inverted yield curve led to a recessionary period with a strong decline in value. This was a financial crisis. It's with COVID. This is the next something. What do you think, Jenny?
Yeah, I just wanted to point out. So when we say the inverted yield curve, we're talking about what the bonds, right? I mean, we mentioned this early on. So why don't you explain that just a little bit more? The bond yield curve is inverted. So if we could just touch on that one more time, I think that may help.
So when I'm getting paid more interest for a short-term note as opposed to a long-term note, that starts to break things in the economic system. So let's talk about what begins to break. The SVB, you talked about it earlier, Jenny. So you got 1% bonds. SVB sold billions and billions of dollars of 1% treasury bonds. 2 years later, rates are closer to 5%. Does anybody want to buy SVB's 1% bonds on the open market?
When they need to sell them. Yeah, because they needed to sell it. People were coming. They needed to sell some of this portfolio, right? And they ended up having to sell it for a huge loss because nobody wants to pay what it was worth 5 years ago or 4 years ago at a 1% rate. So that's why this is such a, this can have huge impacts on the economy as we see here. Generally, you're going to see a recession occur after the yield's been inverted.
Well, let's look at this in terms of how to protect our capital. So what we would suggest is that because these cycles in the economy happen over periods of time that we can somewhat predictably look at, we can begin to see the signs of the systemic issues that are likely to happen because of this inverted yield curve. We would suggest that during times when you see this inverted yield curve starting to get to that 9 to 18 month period, that is a great time for you and I to get defensive and start to leverage this thing called cash. Because often you can get paid pretty well to sit on the sidelines during some of these really difficult economic times. Here's what we would suggest, though. You don't want to be in any one position with more than $250,000 of your money unless they offer what's known as enhanced insurance, where what they do is they help split up in the background to where you have more than one bank that's actually helping to insure your funds. You can do this manually as well. You could, I think there was someone in the chat window that brought this up, Armit. You could split your deposits across multiple banks. And then you could also use different account types. Jenny, talk with me a little bit. What do you mean by different account types?
Yeah, so maybe I have an individual account at the bank. Maybe I have a joint. If it's a joint, it's actually covered up to $250 per person. So that would be covered to $500,000. But you also might have your retirement account. You might have a Roth IRA or a traditional IRA, a trust. Those types of different types of accounts are going to have that $250,000 limit. what happens, what you get concerned about is when that's one specific type of account goes above the 250,000 and it's no longer insured. So we want to make sure that we come up with a way to help protect that, right?
So how we do that at Tradeway is those that are engaged in our long-term investing program, we leverage a brokerage partner called Interactive Brokers. They're the company that helps us to be able to have access to some of these really interesting ways in which they can be a part of helping to protect capital. So they specifically have access to what's known as FDIC enhanced insurance. So for accounts that have enhanced FDIC insurance, you're participating with up to 10 different banking partners in the background. Now that's transparent. You don't actually see 10 different banking accounts. It looks like one, but those that are in the enhanced FDIC insurance program, those 10 different banking partners can give you access to up to $2.5 million worth of FDIC insurance. That's a powerful way to do it. And I don't know why more banks don't do it. It really helps. Then the point number two that I want to make is because of how they manage their cash, Interactive Brokers is paying almost treasury rates. So can you imagine being in an economic difficult time, still almost making 5% on your money while the economy is potentially crashing and stock markets are potentially crashing? That is a very powerful opportunity for us to be able to combine two very important aspects of long-term investing from the Tradeway philosophy. Help to protect the funds, and then also to be able to be in a cash position that allows you to have some flexibility to not have to ride those very strong moves down that happen during these systemic issues. Tradeway's AMP portfolios, we leverage our partnership with IBKR, and we really want to be able to think more like traders. We want to be able to think, what's that risk reward look like? Jenny, what do I mean by risk reward?
Yeah, so we just kind of asked the question, is the risk of potentially being invested for a major market decline, where you could maybe see your account get hit by 20, 30, maybe even 40%, like we did see in 01 and 08, 07, 08. Is it really worth maybe being invested to maybe eke out a few percentage points, or something breaks, like we've been saying? So we take that risk reward into account, even with our long-term, how our long-term management team manages the portfolios.
Excellent. So there is a question I see here in the chat. What does AMP stand for? I should have said that earlier in the presentation. I apologize. I see it so many times. Assisted Managed Portfolios by Tradeway. Assisted Managed Portfolios by Tradeway. It's our team, the long-term investing team, helping to avoid those major market declines with Tradeway's philosophy. And it's all about leveraging the money market accounts when it makes sense. And that brokerage partner, for those that qualify for it, that enhanced FDIC insurance is a huge part of why we built the system. We're looking for a safe haven during difficult times, and Interactive Brokers helps us with that. So let's talk about those bear markets. You mentioned, Jenny, some potential declines. Let's actually look at some history. I'll just explain this chart to you. Here's the time frame down here at the bottom, the 50s, 60s, the 70s. What happens is that we've seen strong market declines, 22, 28, 20, all over history. We can see periodically there's some very strong declines, and these declines are this bright blue bar that you see here. Now the dark blue, let's just look at 2007 as an example. In 2007, the market went down 56%. That is a substantial decline. That was the financial crisis that caused that. By the way, do you know the last time, Jenny, that interest rates were up near 5%?
Was just before that, right?
2007. So there's a lot of people that are like, let's start to set up a lot like what we saw just before the financial crisis. We haven't seen rates this high since 2007.
How many months did that bear market last, Ben?
Oh, that's a perfect question. And that's what this blue bar here is all about. This dark blue bar, it represents how long did the market go down during this economic crisis. So for 17 months, the market declined. And I love to ask the question as a trader, at what point do you think maybe you might have gotten a clue? It doesn't take 17 months for a trader to understand that we're in a sustained bear market. Now, the next bar here, I like to call this, how long did it take to get back to your goal? Because that's what this color is, this golden bar. How long did it take to just get back to even? 49 months. So you had 17 months of decline, and it took 49 months to get back to even. You're looking at 66 months of your investment life. Wow. That is why AMP was created. David Mitchell, our founder, his philosophy is this could generationally change your family to avoid these strong market declines. How drastically different could your portfolio look if these huge declines is not something that your portfolio went through? What if you sat on the sidelines taking advantage of things like IBKR and their enhanced FDIC insurance? What if you were able to get there almost 5% just to be in the safety of their cash? How different could your future look, and how different could the generations that come after you have these same skills and these same knowledge? How might it change the trajectory of your family? And is it worth giving up the short potential gains that you see in a risky environment, the opportunity to avoid these large declines? That's what our system is predicated on. So 27% is what the market went down last year. Let's talk about what's average. Is there a recession coming? Here's what's interesting. On average, a recession, what we see is a 34% decline is normal average for the market. We could see still a 34% decline. If we move into a recessionary environment, that's what the math would tell us to expect. Now, what if we move into a financial crisis? Well, could we be ready to repeat the 56% declines that we saw during the last financial crisis? Let's start thinking differently. Here's the large declines that we've seen. Now, this is the S&P again. What you can see is that the S&P declines happened drastically when we're looking at these recessionary timeframes. We simply want to be prepared in advance when we begin to start to see the signs that a recession is coming, because historically, we can see that recessions lead to strong declines for the market. If we know that that's the pattern, could we apply some wisdom? Could we apply some logic to be able to start to make decisions to maybe get defensive? Well, that's what we're going to propose. So let's talk about what are some of the potential issues. What are some of the somethings that just might be ready to break? Anybody want to know more about some of the somethings that we're tracking? Give me some input in the chat box. Would you like to hear about some of the somethings that we're tracking? Okay, let's move on. Let's talk about some of the some things. Here's some of the potential issues. Now, David Mitchell has shared with us, there are so many things that are happening, but here's some that we just want to call out today. Loan defaults, they're accelerating. They're accelerating, not unlike what happened to our friends in Iowa, where they helped the freighters, the truckers, buy some very expensive equipment, some big rigs, and now they are not worth what they paid for. This is getting interesting, because is there something else that maybe is a little closer to home for all of us? Did anybody try to buy a car over the last 2 years? Yeah. How much did we have to pay for it? Really inflated prices. You know that the defaults on car loans is starting to accelerate. People are just giving back their cars because they can't afford the payments, and it's not worth what's on the books. Who's going to take those losses? The banks are. There's huge potential there that we're tracking. We think that one could be something that breaks. An even bigger something that could break. Commercial real estate market. We don't get this because it's not the way that we think as consumers. But in the commercial real estate market, they don't take out 30-year loans. They typically take out a 3 to 5 year loan. And every 3 to 5 years, they got to go refinance. They got to go refinance. They got to go refinance. And prices have been elevated. Now, especially with COVID, commercial real estate is not worth what it once was. So if you have a commercial property and you were able to get it at 1, maybe 2% loan rates, and now you go to refinance and you're going to have to pay 6%. And it's not worth what it's on the books. Do you really want to go refinance that property at 6%, or do you give it back to the bank? They're going to probably give it back to the bank. And we're starting to see some of that happen even now. Bankruptcies in the corporate real estate market. These companies are accelerating in their bankruptcies. We think that could be the next something that breaks. And then let's not forget that we live in interesting times. There's global conflicts that could easily boil over and start to create global issues, whether it would be Russia with Ukraine and what's happening over in that part of the world, whether it's the Middle East and what's happening in Israel, or even more concerning is China. The Taiwan situation could easily escalate into a global conflict. Any of these potential issues could, in fact, become the something that breaks. And what's interesting is typically we don't know what that something is going to be until after the fact. But what we know from history, the inverted yield curve, typically creates that environment where these bonds that can't be sold for what they're worth creates the economic pressure that causes something to break. Starting to see the signs that something is breaking soon. So with that said, I want to ask, have you ever asked your financial advisor to go to cash? And most of the time when I ask this question, people don't even know they can. People don't even know that they can ask their financial advisor to go to cash. But you are the owner of those funds. That's your money. You should be working with a financial advisor who's willing to help you to protect your assets. Why? Well, let's go look at some biblical wisdom. David, can you help me out with this? Read this verse for me, please, so our friends can see it.
Absolutely. Proverbs 27:12 says, "A prudent man foreseeth the evil and hideth himself, but the simple pass on and are punished."
So much, David, of what we do here at Tradeway is David Mitchell, our founder, he takes biblical concepts and he uses those concepts to create the foundation of what it is that we do. So that word simple there, sometimes it can be lost in translation, but if you dig into the Hebrew word of what that means, simple, it doesn't mean a person who's not intelligent. It's not about mental capability. No, it's about experience. So maybe what we could say is those who are inexperienced, maybe a little bit harsher word, those who are ignorant, that just don't know better. Inexperienced, they're ignorant, they just don't know better. They're the ones that are going to be punished in times of danger. And friends, I just want you to recognize that doesn't have to be you. You may not know about the financial systems. You may not understand all of the things that we're describing in the webinar, but you're no longer without knowledge. You have been exposed to the fact that there are things happening inside the economy. And in our opinion, as investment advisors, it would really make sense for us to get defensive and wait for what we believe to be the economic storm to pass. So do you want our help? Consider joining our AMP, our Assisted Managed Portfolios by Tradeway program. It's our long-term investing program designed for the safety and security and preserving asset through difficult times. Registered advisors, people like myself, Jenny and David, we can help you with creating that plan for helping to protect your wealth. And if you leverage our services, well, we can also help you with being able to understand what's happening inside the economy. And what I've discovered is that often people will use that information in other parts of their investment journey as well. The other part, Jenny, we've talked through this, but I want to make sure people get it. IBKR, Interactive Brokers, is a big part of helping to provide some of that security because of the way that they give access to those that qualify for enhanced FDIC insurance. Pretty interesting way for us to be able to have a lot of the Tradeway mindset for trading, but also a partner that helps us to overcome some of the problems that happen in the financial system. So as you move funds over to AMPed, I want you to think about things like 401ks. Now, Jenny, can 401ks be managed inside the AMP program?
Well, it depends. You'd have to do a rollover into either a traditional or Roth IRA, depending on what it is in there. So we can help with, of course, old 401ks, or otherwise known as orphaned 401ks or 403bs. Other, employer-sponsored retirement plans we can help with. If you are currently working where you have where you're getting those benefits from, you would have to call and ask your benefits administrator if you can roll over any of those funds to a self-directed IRA outside of where it's currently being held.
The question I tell people all the time is call your benefits administrator, ask, how much can I roll over? That's a key question because whatever can be rolled over, we can help you with. So whether it's a Roth or a traditional retirement account, the question is, what can I roll over? Now, health savings accounts, typically those are administered by your employer. Those are not typically capable of being rolled into a fund like this. So health savings account would be a little different, but if you have questions, just call your benefits administrator and ask this question. How much can I roll over? That's the key. And when it's in an IRA, we can actually help you with it. We can help you with investing in cycles of the market. And our minimum investment is a $10,000 investment. Ready to get access to our help as well with Interactive Brokers? We think cash is a position. We say it a lot. Being able to get up to that 4.83% with our brokerage partner is a really powerful way for us to be able to get defensive and yet still have some appreciation on our accounts from those cash balances. That's the goal. So what do AMP members get? Well, with being able to protect with biblically based mindsets, an investing approach that doesn't just do a buy and hold mindset, we think like traders. And we really do work to try to help you to avoid being in the market for all of those declines. When we were looking at that 17-month decline, and I asked the question, at what point did we get a clue? Thinking like traders. We don't want to be in for a 17-month decline. And we use technical indicators to help us to be able to know when we're in an environment in which they're likely going to happen. And we offer these diversified portfolios in the bullish markets. But Jenny, we do one more thing. What's an inverse position? And why do we use them?
Yeah, so at times during a bear market, we will utilize what's called an inverse exchange traded fund, which actually moves up when the instrument that it's tied to moves down. So that's what an inverse ETF is.
We use inverse ETFs related to the markets, like the S&P 500 or or the NASDAQ. So we, during times in which we think the market's going to crash, we'll actually have starter positions in these inverse ETFs. So imagine being in an environment in which, as the market's moving down, you're making money off of inverse ETFs. You're protecting a majority of your assets in cash while the market declines. And then you've got more of your capital available for the next bull. Now, Vinny, we often say this. I want to ask the question, when's the best opportunity to profit in the US stock market? When's the best time for us to get heavily invested?
Yeah, that's going to be the first year after a significant bear market.
So our goal, our thought process, thinking like a trader, get defensive when the risk reward is small. When the potential reward is small versus the potential risk, that's when we want to leverage our brokerage partner and get defensive. And as the market declines, we want to be able to preserve the capital through the decline because we know that history tells us the huge increases that come as people are just getting back to even. Think about what your account might look like if you preserve through that. And now you've got more capital for the next bull market. We think longer term. Preserving in times like this where the market is advertising we're likely going to see a strong decline is worth being defensive while we wait for these things to play out. We don't yet know what the something is that's going to break, but history tells us that something is going to break. It's a great time to be defensive. So if you would like some help with that, well, that's what we're here for. So, Benny, could you launch a poll for me, please? I'd like to get some feedback. We've several friends on here today that maybe would be interested in getting our help. I'd like for you to look at this poll that we just launched. And what this poll does is it helps us as a team to know that you would like to hear from us. Give us a little bit of feedback. How much are you thinking that you may want our help with inside the AMP program? Now, when you select this, it actually tells us that you want us to contact you. And if you're working with one of our advisors, well, that's the second question. You can scroll down a little further on the poll. Are you already working with Ben, Ginny, or David? Just let us know that as well. But one of the things that's interesting here, David, what's next steps, right? Our friends that are filling out this poll, they're kind of giving us what happens next? What can they expect?
Yeah, Ben, guys, everyone is going to be receiving an email from us, right? And in the email, there's going to be a scheduling link. This is an opportunity for us to just visit with you, right? And so we can have a conversation, answer some questions you have, see, is the AMP program going to be the right program for you? Or which program within the AMP program will be the right one for you? So there will be that opportunity. Use that scheduling link to set up a meeting with one of us. We'd love to help.
And David, as a part of that scheduling link, it's also going to include our fee structure. There is a small upfront cost for you to be able to get started with us. Why? Well, we have a whole team of people that actually help you do this. They'll get on a Zoom session. They'll help you to create the accounts in Interactive Brokers. They'll help you with doing the funds transfers. They'll do it so that there's not tax consequences for things like the rollover IRAs. Our team helps make sure all those details get handled appropriately. And it's part why there's a small startup cost to it. Now, what about the longer term costs? There is an annual percentage rate that we help you with for the assets under management. And I like to jokingly say all the time, unlike the IRS, our fees decrease as the amount of your assets grow. So the IRS charges you more and more income tax the larger your portfolios are, right? Well, no, not at AMP. We actually charge you less money with the more money that you bring in. And it's actually why we're asking about how much are you thinking? Because in the consultation you have with one of our advisors, we'll be able to more appropriately help you understand what your fees look like. So great question there that was asking about the fees there, Winston. Thank you for that. It is based on the assets that you have under management with us, which is why we're asking that question. In the invite that you get from us, you're going to see a link to what's known as the AMP story. You can get a lot more information before our call by clicking on that AMP story link that we're going to send to you. What else is in there? Is there any other questions that have come up in the chat window that we should talk through, Jenny, David?
You know, the board is clear. I answered a few in the background, and the board is clear on the Q&A.
Excellent. Well, I do see that there's one there about what about Roth 401k? Yeah, so Armit, the question applies there as well. You simply need to ask your benefits administrator, how much can I roll over or how much can I transfer to another Roth account? So let's say they tell you can move $50,000. Well, what we would do is our team would get together with you. We would create a Roth account for you and with you at Interactive Brokers. And then we would help you with being able to transfer from your existing 401k Roth, and the funds would transfer into your IBKR Roth account. There's no change, there's no tax penalties. That's what our team helps you to do in the background. Great question there, Armit. Thank you. Any other questions, Jenny, that came up?
I'm not seeing any other questions. I just would like to let you know, we can help with individual or joint accounts. We can help with traditional rollover IRAs. We can actually help with SEP IRAs and trusts, entities that you might have. All those types of accounts we can help you with and help manage those funds for you, just so that you know that.
How do you take action? Maybe you're watching this as a replay and you're like, how can I, someone who wasn't here live, how can I take action? Well, you can email us, ampt@tradeway.com. You can request an appointment at ampt@tradeway.com. One of our advisors would be happy to get back with you. Can I just say thank you for your investment of time? Thank you for being with us here today to learn about some of the things that maybe is not so well understood within the financial industry. David Mitchell, other long-term investment advisors, people who have been around for a while, who have lived through several of these declines, are warning all of us that we're probably going to see something great soon. And typically the time to take action is before a storm hits. Think about the analogy. You live someplace where hurricanes are prone. You get prepared before the hurricane hits, or do you wait for the hurricane to be on your doorstep before you start taking action? So friends, we're asking you to consider getting prepared with our help before the hurricane hits. And if we can help you, just let us know. ampt@tradeway.com. Appreciate you being here. David, Jenny, thanks for all the help. You did a great job in the background. It was fun.
Thank you, Ben. Really appreciate it.
Thanks. Have a great day, everyone.
We'll see you soon.